Thanks for watching. I'm Chris Hill, coming to you from Fool Global headquarters here in Alexandria, Virginia, joined by senior analysts Jason Moser and Joey Salitro. Thanks for being here, guys.
Thanks for having us.
We're going to be talking about software. We're going to be talking about SaaS stocks. We're going to be taking your questions, so go ahead and get those ready. And as always, if you could give us a little thumbs up and like the video, it helps other people find the video. And that's what we're trying to do, trying to help folks like you invest better. Let's start, and Joey, I'll start with you. SaaS, software as a service. This is one of those things that has just gotten bigger and bigger in the investing world. If you could, walk us through sort of the basic business model of a typical SaaS company.
Yeah, so what SaaS companies have done is they basically taken away needing to buy like the disk. So the prime example would be like a TurboTax, where you used to have to go buy this CD, pass it along amongst your family members, everybody downloads it on their computer, and you log in. Now, you're just going directly to the site, logging in, or you download it to your computer, and that's the service aspect.
Yeah, I mean, I feel like there needs to be an S in there for subscription, right? Because, I mean, it's software as a service, but the beauty of the model really is the subscription revenue that it continues to generate over the course of years, and if it's a good business, I mean, you're talking about potentially decades even. I mean, yeah, the point that Joey's making there, it used to be somewhat cumbersome to keep on the cutting edge of technology. Now, cloud computing, the internet has put this all out there at our fingertips. These companies can basically push a button and update to all of their consumers, all of their customers at the snap of a finger, which is a very attractive business model.
Well, and we've seen this, just to go completely into a different industry, we've seen this with businesses like Netflix, where the subscription revenue, I mean, that's easy for us as investors to track. That's one metric that we like to see with SaaS, but what are a couple of other sort of crucial numbers that investors should be looking at, Joey?
So the main things I'll be looking for outside of just the revenue growth rate will be the gross margins to make sure they're not just absolutely hemorrhaging cash to be able to grow this business. Usually I'll be looking over 70% if it's a pure play SaaS company. But my favorite statistic is definitely the net dollar retention rate, which can be expressed in a number of different ways, dollar-based retention rate. And that's basically expressed as a percentage where if a consumer spent $1 with you last year and your net revenue is 125%, then this year they're spending $1.25. So that's probably my favorite and go-to statistic when you see how sticky a business is and that they're actually upselling their consumers.
Yeah, one that Joey and I talk a lot about too is billings, right? I mean, that I think is a number that is used for a lot of these companies because it gives us an idea of what they have coming down the pike, what's sort of in store for them in the future. And if you look at it kind of on a quarter-to-quarter basis, sometimes those billings numbers can throw a little monkey wrench into the operation, cause a little concern, and the market will overreact. And we saw this recently. The company I'll talk about a little bit later on, DocuSign, last quarter the billings number was a little bit underwhelmed. The market was underwhelmed by the billings number they turned in, and the stock sold off to that. This quarter it seemed like they righted that ship and the billings number was a little bit more optimistic, telling us that the company was certainly growing. So I mean, the billings number I think quarter to quarter can be a little bit squishy. I think it's a difficult metric to actually really gauge precisely how well the business is doing in the short run, but if you see consistent billings numbers quarter in and quarter out, they can paint a pretty good picture. And if you see a quarter here or there where that billings number underwhelms, if it's a good business, I mean, oftentimes that can open up a little bit of an opportunity for investors. We certainly saw that last quarter.
Whether it's software companies or SaaS companies, Joey, what should investors basically keep in mind? I mean, you already hinted at one thing with, look, some of these companies have done a tremendous job of growing their revenue. Some of them, when you look at the stock, they've earned a pretty lofty valuation too.
Yeah, so that's what's really getting shaky in the market is these valuations are really getting extended where back in 2016, 2017, companies were pricing their IPOs at 5 times sales, maybe 10. Now you've got 20, 30 times sales right out of the gate. So even if they pop more, then you're talking 40, 50 times sales. It gets tough to grow into those valuations.
What else do you think investors should keep in mind, Jason?
So, one thing that has been, it strikes me that, I mean, software as a service, this SaaS acronym has really been thrown around for a while now, and it's presented a lot of neat opportunities for investors. So much so that we are seeing almost every company wanting to call itself a SaaS company now in some way, shape, or form, and that's fine, I get it. But what we are seeing, I think, is we're seeing a lot of these companies that are coming out now. They're software as a service, and they're solving for this particular problem, and that's great. But we're seeing a lot of little startups that are solving like one or maybe two problems, to where it starts to become a little bit cluttered now, and it makes me think of sort of this transition from the bundle in video, the cable bundle. Then people are like, hey, I'm getting all of this stuff. I don't really want it. It's just too much. I want something simpler and streamlined. And hey, there's Netflix, the ultimate software as a service. It streamlines everything. It's a simple one-shot bill. But now we're seeing sort of this reemergence of the bundle, a different bundle, but a bundle nonetheless. I wonder if we're going to get to a point where there's so many different SaaS solutions out there, customers start to become a little bit more overwhelmed. They're looking for a little bit more simplicity. And maybe we see some of these SaaS companies, they don't end up making it, even though they might look a little bit, look a little attractive today.
We'll get to your stocks in just a minute, but look, over the past 10 years, this has been a tremendous growth area. It's been a great opportunity for a lot of investors, but you sort of hinted at this earlier, Joey. We've seen stocks recently in this space really get whacked. Is that justified in your opinion, that having a lower valuation makes a little bit of sense? Maybe it's some investors sort of taking some money off the table, or is that a cause for concern?
I mean, these companies, a lot of them, they're blowing it out of the park. I mean, they're hitting it out of the park in their first earnings report. So it's weird. I was watching CNBC the other day, and they're talking, hey, this company's tanking because they beat revenue and EPS expectations, but they didn't beat by as much as expected. So it's getting to the point where, I mean, these companies can do everything that they're supposed to do, but I feel like investors finally realize, like, wait a second, we're paying 30 times sales for a company growing 40%. Like, do we see a path to profitability? I feel like a lot of investors just start questioning their positions and just start blowing out of them quick.
Well, and Jason, to be on the side of some investors, that's probably pretty fair, because investing is all about the future. And if you're looking at some of these SaaS stocks and thinking, wait a minute, I don't want to pay 30x, 40x sales.
Some people do. But no, I mean, that's a good point. I think today we look at, I feel like we've been talking about this for the last, really probably close to 10 years now, Chris. I mean, interest rates are so low. The returns really are in the stock market. And we know the stock market is one of the ultimate studies in human psychology. And once you get that snowball rolling and you see all of these opportunities, more money starts to flood in and new companies come to the market. And SaaS is really one of those buzzwords that's bringing a lot of investors in who otherwise might have been sitting on the sidelines. And that's great. But again, with these valuations, it's not to say these companies can't ultimately be worth as much as they're trading for today. But when you see these lofty valuations, ultimately what that is, that's the market bringing a lot of success down the road on into the present. And that really stifles those potential returns that we as investors can realize down the road. So that's why, I mean, price isn't everything, but it really does matter. And when you get to these lofty multiples, it's worth exercising a little patience, making sure you understand what the business does, and see if there's a future there. Particularly, are they going to be able to solve more than one problem? Because if this is just a one-trick pony, that could be a problem in a year or two.
All right, before we get to questions from the audience, and keep those questions coming, a lot of great ones coming in, let's give investors a couple of stocks to put on their watch list in this industry. And Joey, you're up first.
One of my go-tos lately has been Avalara. They do tax compliance solutions, and with the main growth engine for this will be e-commerce. So as more purchases are made online, and these companies have to figure out, because of a ruling South Dakota versus Wayfair, these companies are going to have to start collecting sales tax on their internet purchases, even if it's cross-border. So before, where that wasn't as much of a headache, now these companies got to figure out, okay, this consumer's here, I need to collect this much sales tax, pay this tax authority. And I mean, the tax code here in the United States is an absolute joke and changes almost by the minute. That I feel like this is one of those really sticky business models that I always like to look at my companies and think, okay, in a recession, would this be one of the first ones kicked out? And I don't think any company wants to bring tax compliance, something that they're doing in-house, and there really isn't another solution as efficient as they are, that I feel like that wouldn't be what they're trying to downsize or get rid of.
Jason, what about you?
Yeah, well, I mentioned DocuSign a little bit earlier. It's a stock that I own, and it's a stock that I really do think, I think the company is performing wonderfully, and I think the stock is a real opportunity for investors who can look down the road 5 and 10 years and sort of envision holding on to the shares for a long time. I'd be willing to bet that we all here at the table have used DocuSign services at one point or another. You get an email from someone or a company, something asking for your signature, and now DocuSign is turning into really the go-to accepted method for that e-signature. And so I think that as time goes on and we see more and more companies adopting e-signatures, DocuSign is doing something with this thing called the Agreement Cloud. It's essentially taking this agreement, this signature, this e-signature, and managing that relationship from inception to signature to storage to execution to management. And now they've got themselves into the position where they've got 537,000 paying customers, just added 29,000 new customers last quarter, and one of my favorite businesses, Ellie Mae, which was that was acquired not all that long ago, another good SaaS company. DocuSign is getting into the mortgage business, and we had already seen them pair up with Ellie Mae before Ellie Mae was taken private. The real estate business, the mortgage market, there are so many signatures and documents that need to be executed on a daily basis, it seems like, in that market. Just a tremendous opportunity for DocuSign. And again, a stock that I own today and one that I plan on holding on to for quite some time, I hope.
I also own DocuSign, and I recently closed on a house, and I will say that is the one space we really need this, because I signed for my wife, so I had to do my signature and then this whole extended signature, power of attorney, all this stuff to sign for her as well. And it was an absolute nightmare. It must have been 120 different pages where I'm just writing nonstop. I'm thinking, come on, DocuSign, we need you.
Well, if you are at all, if you have any grain of skepticism on DocuSign, Emily Flippen was telling me the other day, she recently moved and had to go to the DMV, the Department of Motor Vehicles, to get all of her stuff changed. And typically you go to the DMV and you've got to be in there, physically show them your person, handwritten, signed documents, notarized, and all, the whole 9 yards. And she said when she went to the DMV, they basically were asking for all of that. Oh, but wait, we also accept DocuSign. And so if the DMV at this point is accepting DocuSign, I think that's a pretty telling sign that these guys are doing something special.
I feel like if cursive writing were a stock, it would be going straight down, and DocuSign is one of the reasons. All right, thanks for all the questions that are coming in. Thanks again for giving us a thumbs up on the video. We appreciate it. It helps other people find the video. Let's get to the questions, guys. A few people asking, many of the SaaS companies operate in really niche spaces. How do you guys get a feel for who is truly best in class in a given space? That's a great question, and I'm assuming at least one of the things is leadership of the company.
Yeah, definitely leadership. I think we always love to see founder leaders at the helm, because you feel like there is, the idea behind the business is still there, helping steer the business forward. But I think that raises really a good point to the risk I was talking about before. You really do have to start looking through these companies and understanding not only the problem that they're solving today, but figure out if there's the potential for them to add on another problem to solve tomorrow or down the road. Because if you do, run into one of these companies, they solve a problem today and it's a great problem they're solving, but they're kind of stuck there and they're spinning their wheels going forward, then all of a sudden maybe they don't look so hot in a couple of years. So I think about Slack for me is when I come back to recent IPO. We talk a lot about Slack, and I'll couple Zoom communications and video communications in there as well. Both companies that focus on a particular niche. Slack in the sort of channel communication in the workplace, and Zoom in the video communication in the workplace, although Zoom is now getting into just the audio communication, and there's going to be chat that goes in with them as well. I do feel like when I look at these two companies, Zoom at this point in the game seems to me to have a little bit more opportunity to solve some additional problems. They seem to be thinking a little bit more that way, whereas Slack, I'm still a little bit concerned that they're really just focused on this channel communication, which is fine, but I think it's going to be very limiting, particularly if they can't develop a product that is super attractive to a tremendous customer base that will be willing not only to pay for it, but to pay more for it as time goes on.
Yeah, you definitely want to see the companies that, they might come public focusing on a niche, but they're raising capital because they want to either make bolt-on acquisitions or expand organically into their own spaces. So Atlassian's one that comes to mind, where they have their Jira was their main product as they came public, and they acquired Trello for the collaboration, and they've made something like 18 bolt-on acquisitions since, to where you can see they come in, they've got their core customer base, and then they're like, hey, we've also got this, or we've also got this. And then that's where you get that net dollar retention going up, because they realize our customers love us, they love our service, and they know that, you know, if we do this as well as we're doing it, then they'll trust us, hey, give us a chance on the collaboration side, and just continue to grow their product suite.
Question from Vladdy, who asked, it was a bit of a rough week for normally high-flying SaaS stocks, including Motley Fool favorites like MongoDB, CrowdStrike, Zoom, you name it. How do you guys handle these kinds of broad sell-offs? Well, they're not fun.
No, nobody likes losing. I mean, I think that really is, that goes back to, I think, what we've been trying to hammer home since the beginning of our company so many years ago, is that ultimately time is how we deal with those types of stretches. I mean, when we are investing in these businesses, investing in its truest form is a long-term exercise. So when we buy these businesses, I mean, we're looking at owning them for 3 years, 5 years, hopefully 10 years and longer. When you can look at things from that context, it makes dealing with, you know, the day-to-day machinations of the market are very impossible to read. It's just very difficult to read. But when you look at that time frame, when you take that longer time frame, it makes dealing with these sorts of stretches a lot easier. Not to mention, of course, diversification.
A question from Paul, who asks, a lot of SaaS companies seem vulnerable to disruption themselves as other companies come out with a better mousetrap. How do we determine how good of a moat these companies have? Really good question, because there's no substitute for a really good moat for any business.
Well, yeah, and that's where I'll always look at an existing customer base, do a patent search to see, you know, if they have, you know, an extra patent over this specific bell or whistle that they just came out with. And, you know, being the first mover always helps. So if, you know, a DocuSign with 537,000 customers, HelloSign, and there's competitors in the space like Adobe Sign, but DocuSign has such a huge customer base already, and they've got the reputation for being great, that almost creates their moat. And then another little thing that I throw into my research is looking at sites that do software review and see, you know, what the people that actually use it, the developers, or, you know, here at the Motley Fool, we use Avalara, we use a lot of the different softwares that I'm investing in, and I'll just go to those teams and say, hey, why do we use this? Did you try other ones? Like, why was this the best? And, you know, almost getting it right from the horse's mouth.
Question from Harley, who asks, it seems like total addressable market is a big part of the SaaS story. How do you think about that for a company like DocuSign?
Well, I mean, definitely, total addressable market is a consideration that I incorporate into every company I consider for recommendation. And in the case of a company like DocuSign, which certainly is going global, has global aspirations, you look at what they do, their core competency in e-signature. Contracts are all over the world. I mean, anywhere you go, contracts and agreements are being executed every day. And thankfully, technology, the internet, has made the world essentially smaller. And so with a company like DocuSign, it almost becomes, I don't want to say irrelevant, but the total addressable market can become so large compared to the size of the company today that it almost becomes an issue that you don't have to really worry about. But I think really understanding the core competency and how well that translates globally, that can give you a good idea of how far the business can actually go.
Question from Mary Ann. Most SaaS stocks are more in the high-flying growth realm. Those are the kinds of stocks that get beat up in a recession. Are there any SaaS stocks that you consider to be recession-proof?
Ooh. I don't know if any stock's recession-proof as much as you may like to think they are, but just like I was saying with Avalara, I always like to look at these companies and say, you know, in a time where a company needs to reduce spending, is this something they would throw out first? I feel like, you know, going from, say, your company's going through some difficulty, you might stop renting a specific office space, go into a WeWork or something like that. Definitely not a good, I'm not a fan of WeWork personally, looking at, you know, the growth rates there and some of the shady transactions within. But I always like to look at, you know, tax compliance. Okay, they're not going to want to figure this out themselves. Figuring out their accounting processes. There's a lot of headaches that go into switching software providers, especially if you have a lot of data stored within these systems. But again, that goes into the initial research process. And much like Jason was saying with total addressable market, I always like to kind of take a 10-year stance. Like, okay, there could be a hiccup in the economy, but this company can last because it's solving a problem for a lot of companies, and the market's just huge for them that they can figure it out. And you always want to look at, they have some cash on hand and how much debt they have, to where if they need to raise capital, they can. They're not just riddled with debt to where they just completely turn off future investors. So that's another key that comes into play.
I think very important here. I agree. I don't think anything's recession-proof. I mean, everything's going to feel a pinch during tough times. But profitable companies tend to do better when recessions hit. A lot of these SaaS companies today are not profitable, so keep that in mind. Some of them are. A company that I love, Chris, Autodesk, recently switching its model over to that software as a service, away from that legacy license. And ultimately, that is a business that they work in simulation and CAD software. A lot of businesses depend on their product day in and day out. Even in times, even in recessionary times, those businesses are still, they have their doors open and engineers are still using that product. So it's not a business that necessarily would be recession-proof, but it's one that's still going to be needed in times of recession. And it's already got a proven business model that can be very profitable.
Salesforce is kind of an OG SaaS company. Is there a point where one of these companies becomes too big to be interesting? Seems like a lot of the Motley Fool favorites are more in the small to mid-cap space. Good question, because that's certainly something that applies to any industry. There are certainly a lot of investors out there who just aren't interested in a $200 billion company, no matter how good the business is being run. They're much more interested in the small to mid-cap size.
Well, yeah, and so my kind of investment style is looking for the next Salesforce, where personally I always look for companies that can rise 10x over the next 10 years, where, yeah, Salesforce might not be able to do that, but I'm looking for that next Salesforce, where I think, okay, this company can grow its $5 billion market cap to $50 billion, much easier than a $200 billion company can go to $2 trillion.
Well, and to go back to leadership, you look at Marc Benioff, the job he's done running Salesforce. I mean, that's one more feather in their cap.
Yeah, and he's always making those bolt-on acquisitions exactly like Atlassian was. So, I mean, yeah, when you talk about, the Mount Rushmore of SaaS, you're definitely having Marc Benioff on there.
I mean, making money is never boring, right? I mean, it's a matter of how fast you're making it. Is that the problem? I think that personally, investing in some of those larger companies is a nice way to afford you the opportunity to build out your portfolio with some of those smaller, I don't want to say more speculative plays, but maybe the businesses that are still yet they're maybe unproven. So we go back to that diversification. Make sure you have a portfolio that's well diversified. Throw some of those bigger companies in there, because they will help you sleep at night when you run into those times. Well, like we saw here recently with a lot of these SaaS names, witnessing a lot of volatility.
I like that Joey just created the Mount Rushmore of SaaS. That's fantastic.
I'm gonna have to finish that one off.
A few people asking some version of this question. Everything going subscription-oriented, software, transportation, even clothes. Are we in a subscription bubble?
We were talking, I think, a couple of weeks ago. Bro and I were on here talking about personal finance and ways that folks could get started investing and find some extra money here and there. And I said at the time, I think it's worth anyone's time to go through and give themselves a subscription audit. If you go through your bank account and your credit card statement and look at all of the subscriptions you have, because you're right. Whether it's video or groceries or, heck, Chris, shaving. I've got a shaving subscription. Everything in the world now is like trying to get you to subscribe to them, and that's a very good point there. It's a very attractive business model. It is super convenient for consumers. Perhaps we're a little bit saturated, and that's okay. The winners will prevail and the losers will go home, but worth keeping in mind.
Another question, can we address high valuations of these SaaS companies? Are they in a new class of companies based on high growth, tremendous gross margins, and limited debt?
Well, yeah, we're definitely, like I was saying before, where IPOs used to be pricing at 5 times sales, then it was 10. Now you've got some of these coming out of the gate 20, 30 times sales, where it might have a penny of profitability, and it's like, oh, well, then let's throw 1,000 EPS multiple to go with 60 times sales, and this is a profitable SaaS company. But they're definitely stretched, so that's where you want to be careful, especially on these IPO day ones with these huge pops. But I always like to almost put my I almost need a graph to say, okay, if this company's growing revenues at 80%, then now where it used to be people were paying 10, 15 times, now it's almost okay to pay 30 times sales. So it's almost, you want to align the valuations with the growth and almost look 2 or 3 years out based on that growth, because then you can say, okay, well, it might be absurd that it's 40 times sales now, but based on that growth, it's 20 times next year and then 10 times the following year, where yes, it gets more reasonable when you put time into play, but if it has that path towards profitability, if it has great gross margins like a Zoom or a Slack where it's over 80%, then you can see that there is the clear path to profitability. And if they have a lot of cash, no debt, then hey, they could be making acquisitions to further accelerate growth. And I mean, that's where kind of growing into the valuations, you want to make sure that your companies can do that.
Well, and you mentioned WeWork earlier. I mean, for anyone who's watching the WeWork drama unfold as they attempt to go public, it's entirely possible that some of those high valuations that we see right out of the gate might be self-corrected because of what WeWork is trying to do.
Sometimes the market is not so forgiving, and I'm happy to see that WeWork is being given such a hard time because I think it deserves it.
They should have called themselves real estate as a service. And then, I mean, that valuation, either that or partner with Beyond Meat to have some Beyond Burgers in all the locations, and hey.
Well, I think that was in their S1, right? Space as a service. I mean, I'm pretty sure that was the term that they used in the S1, which that was my first sign. I thought, wait a minute.
I thought they were trying to elevate consciousness.
That too. I mean, hey.
Which confused me altogether too. I was like, wait, what is this meditation?
Kaylee with a comment, not a question.
Oh, no.
Joey, Peyton and Blake say hello. Question from Luis. Pardon my ignorance, but if a large tech company decides to buy DocuSign, what happens to my investment?
Well, I mean, that's a good question. And oftentimes with acquisitions, you're going to see one of two things happen. Either the company is going to acquire the other company for outright cash, and you'll just be given cash for your shares, or they'll use stock as the currency to buy the company, and you'll get stock in the company that is making the acquisition. Either way, typically, if it's a fair deal and the board is on board with the deal, then the acquisition is going to happen. You just need to understand exactly how they're going to fund it, and ultimately, you're not going to really have much say-so in the matter. So you need to figure out, A, what you want to do with that extra cash, if it is going to be an all-cash acquisition, or B, if it's going to be a stock acquisition, do you want to own shares in the acquiring company? Because if not, then you'll need to liquidate those shares once you actually inherit them when the transaction closes.
Yeah, and I had this similar situation where SendGrid was one of my holdings. They got bought by Twilio, and I'm looking at it like, okay, I definitely want to own Twilio. I'll let those shares convert. And the cool thing is, because it was both cash and stock, that I was given a little bit of cash. I believe that's how the transaction happened, but Twilio stock went on to, I think it rose like 50%. So like, I was locked in at, I was getting, point so-and-so shares of Twilio for each share I held of this, and as that just kept going, where that original purchase price might have been 42 a share, SendGrid just kept running and just kept flying high, and then yeah, it converts to Twilio, and we know how that's turned out, and it's just continued to go up. So yeah, I mean, if you like the acquirer, then stay the course if they're giving you stock, and if it's all cash, then hey, congratulations.
Last question before we wrap up. A few people asking, how do companies meaningfully grow that dollar retention number? What goes into it?
So a lot of the dollar retention, so if they're trying to consistently grow that, that could be they're adding another solution, or so let's use Blackline, one of my holdings. They do accounting, basically accounting software as a service. So what they'll do is you might buy a specific number of seats to use that. Now say your company buys 10 seats and then you hire 5 more accountants, they need access to that, you're buying 5 more seats. So you can upsell using the existing product, or they could say, now say they bought another company that does tax compliance or such. They could say, okay, hey, we've got this accounting software where you're paying this, but if you also want to have this side of it, or we'll do all these filings for you, then hey, that's going to be this price and we'll step you up to that next time around. So it's basically broadening the product suite, or people basically adding more licenses or needing more seats to log in.
And I think churn also is another thing to keep in mind is ultimately, when these companies sign customers, they want to keep those customers. And when they don't keep those customers, that plays into that retention rate. When they do keep those customers, obviously that is a positive. So when you see that net retention rate, churn is something that goes into that as well.
And the ultimate key would be if you can find a company that is adding a bunch of clients, the existing clients are spending more, that's been like the ultimate recipe to success, because then you can see, okay, all these new customers, now if these customers that have been around for 5 years have been increasingly spending, $1, $1.25, $1.50, all compared to year one, you can see, okay, all these clients like DocuSign just adding 29,000 customers or something like that, those customers are year one, now they could start growing to where they're spending more and more. So you get almost that cohort where hey, year 1, year 2, year 3, but new people in year 2, and it's growing from there.
Yeah, it's kind of like a restaurant comp, right? I mean, that first year a restaurant's open, they're just kind of getting their feet underneath them. The sales are probably going to be at a sort of certain base level. But once you get a matured restaurant base there a few years down the road, you could see a meaningful increase in sales as time goes on there. Certainly the same thing would come into play with customers of these software as a service companies, just as Joey was saying. They buy in for one product, but if they like what they're seeing, they'll add more, and now it becomes a very valuable customer over time.
All right, Jason Moser, Joey Slitro, guys, thanks for being here.
Thank you.
Thank you so much for watching. Please give us a thumbs up if you like the video and click subscribe. It's free. We're going to be doing YouTube Live, taking your questions every week. Thanks again for watching. Fool on.